One of the factors which has been attracting the attention of the markets and in fact deciding the direction of the course of the markets is the liquidity conditions. The liquidity conditions have been quite tight in the interbank market in the last couple of months. The deficit in the interbank market has grown to about 1 lakh crores. It has been around 1 to 1.5 lakh crores in the last 1 month or so. Liquidity conditions, along with interest rates and earnings growth and sentiment, decide actually the movement and direction of the markets, both in the short term as well as in the long run. Liquidity conditions are reflected in the interbank liquidity situation. If the interbank liquidity is in deficit, it means that the system is short of funds. What are the factors which affect interbank liquidity? One of the most important factors which affects interbank liquidity is the government borrowing program. The government borrowing program, the central government borrowing program is close to 2 lakh crores. The state government borrowing program is of to the same order. So both of them put together is about 3.5 to 4 lakh crores. This affects liquidity because whenever the governments borrow, that much of liquidity is taken out of the system. Second factor which affects liquidity is mainly the FII activity by way of FII sales or purchases into the domestic equity markets. When they take money out of the system, they sell on the stock market, take money out of India, this systemic liquidity comes down, and that also affects the money market conditions to a large extent. In an economy which is going through cyclicalities of growth, we would see the credit growth also picking up gradually. The domestic credit growth has moved up from single digit to double digit. In the last few months we have seen it moving up. That also affects liquidity conditions to a large extent. The liquidity deficit in the interbank market has been already made good by the Reserve Bank to a large extent through open market operations, because RBI supplies liquidity through OMOs and repurchase agreements into the interbank market. RBI supplies liquidity. The second factor is that RBI has already eased the norms for banks to borrow more based on the SLR securities, surplus SLR as also SLR securities which they are holding. There have been some measures involving National Housing Bank to give some additional credit to housing finance companies to ameliorate the situation. There is also a move which we have seen in the last few days for banks to buy up a part of the housing finance companies' portfolios. So there have been various steps that have been taken by the RBI and also the banking system as a whole to reduce the liquidity deficit conditions in the interbank market or to moderate it to a large extent. One of the reasons which has been influencing all these factors is the rise in interest rates in the US, because the US economy is growing. US equities have been doing quite well. Therefore, there has been a movement of money into US dollar denominated assets. US Fed is expected to hike rates further. Therefore, it's only natural that money could move into the US markets. Domestic inflation at this point of time, going by the last 2 months inflation CPI numbers, it seems to have moderated. But there is no firm outlook that inflation would go down from the current levels. In fact, the weaker rupee and the higher inflation and the higher oil prices would all come together to put some pressure on interest rates. Therefore, the liquidity conditions remaining deficit structurally, even though it is moderated by RBI lending money into the markets, even then this liquidity deficit is likely to put some pressure on the interest rates in the domestic markets. At this point of time, there is another factor which we need to look at, that is this liquidity deficit has another aspect which is mainly of a company and sector specific basis because a lot of these issues and problems came to the fore because of the ILFS default on its payments obligations, debt service payments obligations, and also on account of the subsequent cascading impact on many housing finance companies and the difficulties which they faced in mobilizing funds in the domestic markets. Rates on commercial papers have moved up. So it has another dimension also because of the difficulty which some of the corporates in the financial sector have been facing to mobilize additional resources. As far as investor portfolios go, with liquidity conditions remaining in the deficit territory, though it is made good by the Reserve Bank of India, it is prudent to stay at the short end of the curve, short end of the market, and keep portfolios in short-term debt or very short-term debt for the time being. This has been the Emkay view as far as portfolio positioning in debt is concerned. Thank you very much.